So we left the EU earlier this year, and then we entered the transition period. And then coronavirus came to the UK and diverted our collective attention away from Brexit. Since then, companies have had to grapple with both the immediate impact of the pandemic on their business and also how to prepare for the end of the transition period on the 31st of December. This week, we see the UK and Brussels still trying to arrive at some kind of trade deal post 31st of December. And so even now, at the 11th hour, there's still great uncertainty over how the post-Brexit landscape will look for businesses as we go into 2021. Now, this means that there are aspects of financial reporting that are likely to require more attention as our new relationship with the EU, in whatever form that takes, begins next year. So this section of the presentation, we're looking to highlight a few of the more significant issues that we think need to be considered as we prepare financial statements over the coming months and as the exact form of our new relationship with the EU becomes clearer. Next slide, please. So the first issue is impairment of assets. Depending on the shape of any deal that is reached, Brexit may affect the recoverable amounts of assets, possibly leading to the need for impairment provisions in the accounts. So we need to be alert to impairment indicators specifically resulting from Brexit. Stock and inventories are reviewed for impairment on an annual basis, and so there we'll have to consider whether the terms under which we are leaving the EU create an adverse legal landscape which could affect our ability to sell stocks into our usual markets, or could significantly increase the costs of doing so. There could also be other issues. For example, a decrease in the availability of labour supplied by EU workers could push employment costs up. So there could be factors that either bring the net realisable value of stock down or push the cost up, which either way may lead to provisions being needed against stock where previously there were no issues. Where we have other assets, such as property, plant and equipment, we review those whenever there are any indications that recoverable amounts are below the carrying amounts in the accounts. So when considering the impairment of these types of assets, we should remember that recoverable amount of an asset could be its value in use to the business, if that is higher than the market price it could achieve if sold. So therefore, even if commercial property values are adversely affected in any post-Brexit slump, if the property is still fully utilised in the business rather than surplus to requirements, the carrying value in the accounts may not be affected. However, we should still review the useful life of the asset, as that could be affected, and that would have a follow-on impact on the depreciation charged through the P&L. And one final point on assets, where the post-Brexit landscape creates any uncertainty, if we need property valuations for the accounts, you should consider using professional valuers rather than relying on direct evaluations. Because even though professional valuations are not mandatory under FRS 102, in such a climate, it's probable that directors will struggle to make reliable valuations, and auditors will probably expect professionals to be involved in the valuation process. New slide, please. So next, provisions. With provisions, you need to be aware of over-providing based on Brexit uncertainty. Costs anticipated and associated directly with Brexit should only be provided if there's a legal or constructive obligation to incur those costs as at the balance sheet date. So for instance, if a company is pushed into restructuring, a constructive obligation to make a provision only exists at the balance sheet date if those plans to restructure have been formulated by the year end and formal announcements have been made to those affected by the plans. Just having an intention to restructure at some point in the future isn't sufficient grounds to recognise provision at the year end. Where there's a high degree of uncertainty caused by the new business landscape, it's likely that directors will more than ever be required to make judgments and estimates that significantly affect the accounts. They should therefore be prepared to disclose those judgments and estimates in the accounts, and disclosure should focus on the specific amounts in the accounts that are at risk of material adjustment in the next year, should those judgments and estimates change. Next slide, please. To capture all the material impacts of our departure from the EU, you should plan to undertake a comprehensive post-balance sheet event review. Now, where such a review identifies relevant information, we need to assess whether the information provides evidence in relation to circumstances that existed at the balance sheet date, which would mean it was an adjusting post-balance sheet event, which required adjustments to the accounts, or whether it relates instead to circumstances which arose after the balance sheet date, which, although these may ultimately impact the amounts recognised in the accounts, they would be a non-adjusting event at the balance sheet date, simply requiring disclosure in the accounts with amounts left unadjusted. Now, with the transition period ending on the 31st of December and the new relationship with the EU beginning on the 1st of January, this could present challenges for December 2020 year ends in particular, as it may be difficult to establish whether an event after the year end, in Q1 2021 say, related to conditions existing at the balance sheet date or not. We can see scope for different interpretations being applied, so just be prepared to back up any judgment calls with your auditors. Next slide, please. Should we get to the end of the transition period, and as is looking likely, there be no deal or a poor deal, the resulting complexities for businesses are likely to require more detailed disclosures in the accounts, even for small companies that apply Section 1A of FRS 102. This is because of the overall true and fair requirement, which requires directors to make disclosure over and above those that are mandatory if such disclosure is necessary for the accounts to show a true and fair view. This is where a strategic report or a director's report could be useful to provide context to a reader of the accounts, and also to give an insight into the company's future post-Brexit and its ability to deal with the anticipated challenges and uncertainties. Now, small companies are not required to file a director's report with the accounts, but they can always choose to do so if they think it'd be helpful for outside users of the accounts to better understand the position that the business is in. Next slide, please. Finally, we have the issue of business continuity. Many businesses may find the switch to a new relationship with the EU is relatively seamless if they have limited trade with suppliers or customers on the continent. However, for many more, this will be a challenging time for them. Sales contracts could become less profitable due to customs duties, tariffs, delays at ports, unfavourable exchange movements. In worst case, contracts could become onerous unless the business is able to renegotiate terms. All these factors need to be considered when thinking about the company's ability to continue in business. And as we said earlier, as Craig said earlier, appropriate disclosure will need to be made in the accounts. Where the business will be heavily dependent on the support of shareholders or third-party funders for its continued existence, then confirmation of that support being forthcoming in a landscape of higher commercial risk should be obtained. Next slide, please. So, lots to think about there. We'll now move on to look at the ways in which a parent company can be exempt from preparing group accounts and how Brexit could impact those. Next slide, please. We'll start off with a quick recap of the exemptions. Firstly, there's the exemption for a parent company that is itself small and heads up a small group. There then go on to be further possible exemptions for intermediate parent companies that don't meet the small group requirement. So taking the first of those exemptions, what do we mean by a small group? Well, the thresholds are there on the slide. We've got three benchmarks: turnover, balance sheet total, and employees. And we've got net thresholds and we've got gross thresholds. The gross thresholds are what you look at first. You simply take the parent and the subsidiaries, add the figures together, and see if you breach the gross threshold. If you do breach it, then you maybe look at, so the gross thresholds are without taking into account consolidation adjustments. If you breach those gross thresholds, then you can look at your consolidation adjustments, take those out, and see if you fall within the net basis. And to qualify as a small group, you have to satisfy two of the three, net or gross, or a mix. Next slide, please. So just to point out that with those gross thresholds, there is the possibility for a group containing a medium-sized company to still be a small group, but critically, the parent company must itself be small. Next slide, please. So we know what small means, and we tick that box. but there are still eligibility requirements that we could fall foul of. So we need to make sure that our small parent company is not part of a wider group that is ineligible. Now, the current rules on group ineligibility say that a group is ineligible if it contains either a company with shares traded on a regulated market anywhere in the world, or if it contains a body corporate other than a company with shares traded on an EEA regulated market. Now, when the Brexit regulations come in at the end of this year, those ineligibility criteria will change so that now a group is ineligible if it contains a company or a body corporate with shares traded on a UK regulated market. Next slide, please. So this will therefore narrow the scope of ineligibility. And so once the Brexit regulations come in at the end of this year, it may be that more groups qualify as small, and so that they don't have to rely on the intermediate parent exemptions to get exemption from your parent group accounts. Next slide, please. So that takes us on to those intermediate parent company exemptions that may be available to a parent company that fails to qualify as small. Under Section 400 of the Companies Act, if you're an intermediate parent company, you could be exempt from parent group accounts if you're included in the accounts of a larger group based in the EEA. Or under Section 401, if you're included in the accounts of a larger group based anywhere else in the world. Now, to be able to take those exemptions, there are certain requirements that need to be met, certain hoops that need to be jumped through before you can do so. And one of those is that you need to file the consolidated accounts of that larger group at Companies House, and those accounts need to be in English. Next slide, please. When the Brexit regulations come in, they'll have the effect of changing EEA stroke non-EEA to become UK stroke non-UK. Now, what that means is that Section 400 will no longer be available to companies with an immediate parent company outside the UK. So if at the moment I'm a parent company myself, but I've got a parent further up the chain, say in Germany, currently I can claim exemption to prepare group accounts on the basis of Section 400. However, once the Brexit regulations come in, I won't be able to use Section 400. Not a problem, you might say, I'll just fall back on Section 401, which I can do, however, provided the consolidated accounts of that non-UK parent are drawn up in accordance with the Companies Act 2006 and also UK adopted international accounting standards. Now, at the moment, UK adopted international accounting standards are the same as EU adopted international accounting standards, so there's no real change there. But we see this could be an issue in future if the UK and the EU take different approaches to future standards and amendments, and our accounting framework ceases to be equivalent. So we could potentially have the situation where, as a result of Brexit, we have more parent companies that are able to take the small group exemption, but we have less that are able to take the intermediate parent exemptions. So just something to be aware of if you are an intermediate parent or a parent company and you currently claim exemption from parent group accounts. Okay, next slide, please. Just one point on audit exemption and Brexit. At the moment, if you are a subsidiary undertaking and you're not small, the only way you can get audit exemption is if you have a parent company within the EU that's willing to provide a parent guarantee. With Brexit coming in, that'll only be available to subsidiaries of UK parents. So again, something to bear in mind if that affects you.